Gold, as of today, is $3,842 when I last looked, up 45% this year. People are waking up, both individuals, central banks, institutions. So the race to 5,000, that could happen in the next 12 months.
Hi, everyone. Welcome back to Wealthion. I'm Mario, the channel's producer, and today we're doing something a little different. An AMA, Ask Me Anything, with Brett Rentmeester, founding and managing director of WindRock Wealth Management. Hi, Brett. It's great to have you today. Thanks for joining me.
Nice to see you, Mario.
But before we dive in, if you'd like Brett and his team at WindRock to review your portfolios and apply some of the same thinking he'll share today, you can sign up for a free portfolio review at wealthion.com/free and select WindRock Wealth Management in the form. And if you've got a question for Brett as well, drop it in the comments below. He'll be jumping in to answer as many as he can. So today we'll be covering everything from how to invest safely in today's market to whether gold could hit $5,000 and even whether we're living through an Austrian economic crack-up. So stick with us. There's a lot of ground to cover. So Brett, are you ready?
I'm ready.
All right, let's go for it. So the first question is very interesting. It's definitely interesting. As an investor myself, it's something that has happened to me, and I'm sure a lot of people has had this experience. At Cloud Richardson asks, one of his stocks is down 35%. How do you decide when to sell versus when to double down? What do you think, Brett?
Yeah, I think the simple answer is normally you get into an investment with a certain thesis in mind. So a lot of times when we get into investments, we try to stage it in maybe two purchases. So we make the first purchase, we wait a little bit, we look for another opportunity, and if it's down, we view it as an opportunity. But that's only if the thesis is still consistent with why we're owning it. So I think that's the first piece of it, is the fundamental reason you're buying it still the same story, or did something change? The second part of it could be the macroeconomic environment's changed and all of a sudden something popped up that wasn't, formerly there. That has to be certainly considered. And I think the last is just position size percent. Are we talking about, quarter, 0.25% of your portfolio or a 5% position? You might treat those slightly differently, right? But again, I think the main thing is the fundamental story of why you're in the investment unchanged. If the answer is yes, you continue to be a buyer. If the answer is no, you're probably a seller.
Yeah, it makes perfect sense, right? So as long as your thesis is intact, why not more? It's just going to give you more upside in the end if you're buying at cheaper prices. But one question, how far are you willing the market to tell you that you're wrong until you just stop buying and realize, okay, there's something crazy going on here, and I understand it?
Well, it's a good point. I don't think there's a magic number. I mean, we have invested historically in a couple of very volatile areas and use this methodology that includes cannabis stocks, things that they could fall 50%. It includes things like cryptocurrency, which despite how well they're doing, they could fall 50%. So I think it's more about the thesis and how well thought out it is. But yes, I guess if you're an individual investor just buying an individual stock and something loses a quarter of its value, it's probably a good moment to reflect on whether the story is really continuing on or whether you've missed something. I should add, Mario, this shouldn't be construed as investment advice. We're just here kind of making general commentary, and that really investors do need to talk to a registered investment advisor. And we'd be happy to talk to them as well. But if they've got somebody else, these are just general kind of 101 pointers to think about.
Absolutely. This is just for informational purposes and not trading or investing advice. Thank you for adding that, Brett. I was just going to reflect on what you were saying. It's like that old adage, if you have a stock and it goes down 50%, well, all of a sudden you need 100%.
Yeah.
To make it back, right? So let's go back. Let's go to the next question. And this comes from J. Massey 0405. And he asks, with the Fed now starting to cut rates, I'm thinking about putting $20,000 into stocks for retirement. What's the safe way to approach that? That's an interesting and hard question, I would say, considering how high markets are. What do you think, Fred?
Well, my first reaction is I don't think the Fed cutting rates alone is the green light to just start investing and taking risk, right? Oftentimes the Fed's cutting on weakness. I don't know if that's necessarily the case here just yet, the cutting on weakness, but I don't think a simple measure like that should be the catalyst for, hey, I'm going all in or I'm not. So it's that kind of mindset. I think overall, it sounds like a company retirement plan, something like that. I think this has to be a longer term thesis. And I guess the two just fundamental truths of long term investing, especially in a company plan where there's limited diversified choices, probably are diversify and consider dollar cost averaging, meaning you don't have to put every dollar in today. You can wade into it over time if there's caution. And I think you were alluding to, we're at a very tricky juncture. There are some very fantastic technological breakthroughs happening right now, which of course range from AI, but also include robotics and drones and a lot of exciting things we can think about. But we also have to acknowledge the debt levels in the world and the high valuations of U.S. stocks based on historical measures. So I think there's a little extra caution, even though I think there's still very real opportunity ahead. So with that in mind, diversifying plus considering dollar cost averaging is probably the right approach for some people.
Throughout September, we're shining the spotlight on gold with a lineup of expert conversations, sharp market analysis, and practical investment guidance. To dive deeper, make sure to grab our complimentary gold investing report using the link in the description below. And Wealthion, together with SCP Resource Finance, will be hosting a global silver conference this October in Toronto. Eric Sprott will be delivering the keynote, and it promises to be a landmark gathering for silver investors. You can find out more in the details in the description below.
Yeah, makes sense. Do you have different advice whether a person that comes to you with this question is 40 years old, my age, or is 65, 70, which is just basically getting into retirement, right?
Yeah, I think so. I think the more risk adverse you are, it could be because of age, it could be because of risk tolerance, a number of factors. The more you're apt to want to diversify and take it slow and dollar cost average and not make a timing mistake, right? Everybody's fear is, hey, I'm putting a lot of money to work, and it's the peak in 1987, right before Black Monday, when things crashed 25%. I think that's kind of the fear and what you're trying to get away from. But as a general practice, even dollar cost averaging for more risky investors is fine. It doesn't mean you have to stretch it out, purchases out over a year. You might stretch it over 2 weeks. So I think it can be tailored to someone's risk tolerance. And all else equal, I think you're right. The younger you are, the longer the time horizon, or even the more money you have in some regards, right? If this is money you don't really need, or it's long-term money versus, hey, I may need this in 2 years to buy a house. I mean, those are different kind of considerations that investors have to think about. And clearly, if it's money you might need, or you're more risk adverse, or you're concerned about the market levels, then you should see a caution, flashing yellow sign. It doesn't mean don't invest. It just means invest methodically and with a little more care.
Yeah, I love it. I can't agree with you more. That's well put. So now, for the third question, Dave Stone wants to know, are there any areas, okay, this is going to be interesting, in today's market that are undervalued and attractive?
Yeah, it's hard because it's kind of like the tide has lifted all boats here to some degree.
Right.
Now, clearly, technology stocks have led the way. The U.S. equity market has led the world. You've got all these kind of themes. I guess if we just stick with the U.S. and broad observations, you can look at the various sectors of the S&P 500 and say, what's done well and what's near its all-time historical high valuations and what's lagged. And there's kind of three sectors that have lagged: healthcare, energy, real estate. That's of the last year or two, recent history. Healthcare is kind of a mixed bag. It's something that might become attractive to us in the future, but we're not really seeking opportunities right now, in part because the system's a mess. The whole cost structure, the whole medical system, it seems ripe for disruption and AI getting in. And quite honestly, I think a lot of faith has been lost in the big pharma companies and other things. So we're sitting back a little bit there, even though there's probably some stocks and some areas within that might be attractive. Energy is interesting. We really weren't energy investors per se until COVID, when energy, you might remember this, when oil actually went negative.
Yes.
Yeah, it should never happen, right? It's one of those things. But we were energy investors from that around that point onward, and positions have done great. But I think today the value in energy is, I think, thinking through this story of reinvesting in America in AI, and if we're going to win as a country, we're going to need to support AI. We're going to need to bring investment dollars to America, and we've got to do that with cheap and abundant energy. And we're looking for areas in energy that have a tailwind behind them, but from a price perspective have not performed well. And that's always a hard thing to invest in. We do that a lot, but for an average investor, it's very difficult to get in something that's had lousy 3-year returns. So 2 areas, considering we're actually in energy drillers, so drilling companies that are exploring and drilling and getting oil and natural gas out of the ground. It's been a very depressed area, in part because the last administration had really clamped down on it. And second, natural gas. It's clean, it's abundant, and probably going to be one of the key areas to fuel the growth in the energy sector to support the future of AI in America. So I think there are opportunities, but they're select. And the last is real estate. Now, talk about commercial real estate broadly. That excludes single family homes that people own. Mm-hmm. I think we have some caution there. Seems like prices are, people are locked in their homes because rates are low. But prices in a lot of these markets just seem like they've gotten way ahead of themselves. Not saying there's a massive correction to come, just I think there's a little caution there. Commercial real estate, we're still concerned about office buildings because the data is showing, huge vacancy still. We're still concerned about a lot of the big cities. Where are we finding opportunity? We're finding opportunity in niche hotel projects. We're finding opportunity, generally speaking, in what I call multifamily or apartments in Sunbelt states. There was a little overbuilding in that sector, but I think when you look at the data, people are still moving to areas where there's job growth, where taxes are lower, and where there's literally sunshine instead of winter. And these are generally freedom kind of states that people are seeking out. And even though they got a little bit of a boom post-COVID that maybe went a little too fast at the time, a lot of the data is showing that since we had that banking crisis that was quickly swept under the rug in 2023 with Silicon Valley Bank and others, a lot of the regional banks pulled back on lending. And as a result, less lending went to real estate development. And with a lag, the project that doesn't get funding 3 years ago is coming on market now. So starting next year, we think the dynamics change in a lot of these key markets, and there's a lack of supply again, which is favorable for people that own or are developing the right kind of rental real estate. So I think those are 3 areas. A fourth that we've spoken about is the whole cannabis sector. People have to be careful there. It's highly volatile, but there's some catalysts, in particular in the Trump administration, talking about recategorizing it, and it's an area to at least educate yourself on.
Thanks, Brett. Super interesting. I can encourage viewers more to go and watch the interviews that Maggie Lake did with your partner, Chris Casey, on cannabis and gas itself. The gas interview was released last week, and it's short, sweet, and very informative. So I know that private investments is a key space for you guys. When you're thinking about commercial real estate, multifamily homes, and all this real estate that is in the Sunbelt areas that has potential tailwinds, as you were telling us, is this something where investors really have to talk to someone like you, or they can find it in the public markets?
Yeah, I mean, the particular case I'm describing, what we've done in this area, considered build to rent, where you're building these communities that are kind of like walled, gated neighborhoods, but they're casita style 1 to 3 bedroom homes that are rented out like apartments. Those kind of opportunities are very hard for individuals to find directly. It's not impossible, but generally people find most of these private investments through an advisor who's doing due diligence and has a network. Again, not to say someone can't themselves find some of these opportunities, but I think it's a different opportunity set than, say, buying real estate investment trusts and just publicly traded big real estate companies, where you're probably going to get, on average, more of an emphasis on big cities and office, etc.
Right, and that's where I would say WindRock, your firm, has an edge, right? So I want to remind viewers that they can go to wealthion.com/free and get a free portfolio review with Brett and his team. So let's continue. Brett, this is an area of much interest, I think, for everybody. And it's a question from Alex Wu, and he says, with AI hype pushing tech stocks higher, but debt levels also soaring, is this rally sustainable, or are we looking at a bubble? I feel like things are very bubblicious indeed. What do you think?
Yeah, I mean, listen, if you just look at aggregate data, and we already were talking about it, the valuation of the US stock market on a number of indices is at record highs. Price to sales ratio is a good one. It's higher than it was during the tech bubble, right? That's generally not a good omen. The top 10 companies in the S&P represent 38% of the index. So a lot of the performance is being driven by the top 10. That kind of concentration is generally not good long-term for investor returns. So let's acknowledge that those are pushing historical norms. Now, let's talk about a little bit of the positives for a moment. It probably means you're not getting in at a great valuation point, right? You've missed the easy money. However, the AI companies in general are meeting earnings. And what seemed like very expensive price earnings ratios a couple of years ago for some of the big tech companies have been supported by their performance as far as their actual earnings. So a lot of people will compare this to the 1999 tech bubble peak. And there are some similarities. These valuation things are something to take seriously. However, in that period, you had a lot of dot-com companies with no real end demand. It was kind of a bridge to nowhere. Right now, I think on the AI stuff, you've got real consumer demand, and almost every industry will be touched by this, right? Also in 1999, because of Y2K concerns, they were tightening interest rates. So pulling liquidity out of the market. Right now, we're on an easing cycle. So that is to say, there might be more legs to this than meet the eye, but I think caution's warranted. The way we've approached it is we are in AI, but we're not chasing the big winners. We've positioned ourselves to get into things that are good relative values. I can't name names per se, but there's one we really like that focuses on kind of the future of robotics. So we've done some of that. And on the other end of the spectrum, in the private markets, if people have access to venture capital or startup money, a lot of the startups are focused on disruptive AI or agentic AI, these agents that are going out and actually solving real world problems in different domain areas. And I think, those will get gobbled up by bigger competitors. So I don't think we're near the end of the AI story. I think we're closer to the beginning, but that doesn't mean we can't have some big correction at some point where people say, this just went too far too fast. I think that valuation risk is very real. So people have to go in understanding, the balancing act here of investing. So I don't think it's ignoring the space and saying it's going to crash, but I also don't think it's just going all in, assuming, it'll be straight up. I think there's a little caution. And for us, that's meant in practice being in these names, but when they have huge run-ups, we will be aggressive profit takers and take them off the table. I mean, that is one way to kind of keep your allocation within a boundary you're comfortable with.
Right. It's the wise way of managing this very hot market. Yeah, absolutely.
Yeah.
Chris Casey, your partner, he was talking about why gas is such an interesting opportunity because of the enormous demand that AI, he also talks about crypto and EV, but all of this is tech, right? Has to do with gas. So again, super interesting interview, and I'll put the thumbnail in the link below so people can watch it. Is there any part of the tech sector that you think is more resilient, or is the smart play to what I alluded just now, instead of going to the gold mines, buying the shovel makers, so to speak, like in this situation with gas and AI?
Well, listen, I think the main theme is AI, and I think it's very real. And the question is, how do you express that? I think the more resilient, safer plays are private markets where you're getting in early. So if you overpay for a startup, they value it at 60 million and maybe should have only been 40 million. If it succeeds, that's not really going to matter in the long run. Whereas if you chase one of the market leaders at all-time high valuations, the largest companies in the world, there's a safety net kind of feeling with that, but nobody's ever really gotten rich doing that, right? So I think that's that. And I also think maybe the pick or shovel analogy is more about energy. All the data is showing to build out AI, we need to double or more kind of the energy output of the US. Well, how do you do that? Utilities are a sector that may benefit, natural gas, oil, things that America is abundant in. That is a backdoor play to this boom that I think there's opportunity in. So for us, again, it's like selective AI companies, public companies, paired with startup venture capital style players in the space that are actually solving real world problems. That's a key to it. And then in the middle is this whole energy infrastructure piece of the equation. So again, not advice, but from our perspective, that's how we're sizing it up at the moment. Now, if some of the market leaders correct by 50% or something, we may be buying them. But for right now, we're a little cautious just chasing things that are at all-time highs that have been clear winners over the last year or two.
Right. That makes a lot of sense. Thank you, Brett. Let's go to this question from Mike Shaw. He is asking something on portfolio management in today's macro environment. So he says inflation is still above target. The Fed, as we just said, started cutting rates after a long tightening cycle. How are you adjusting portfolios compared to the old 60-40 model? And for viewers that don't know, that 60% stock, 40% bonds, it tended to do very well for many decades.
Yeah.
The bread and butter for investment managers, right?
Yeah, listen, I mean, let me just start that by saying a lot of performance is driven by financial conditions. And so you go back to the early 80s, interest rates were close to 20%. We've been in a downward, rates have come down. They went to basically zero in the US and negative rates in Europe, right? And so that's propped everything up. So it was a beautiful period to just own stocks and bonds and things that responded to that. But now we're in a different environment. Now we're turning that corner. And even though we're in a little bit of an easing cycle, I don't think anybody's expecting rates to go back to zero. So in that kind of environment where there's debt and still budgets, despite all the work being done, that are not sustainable, that are deficits, I think you have to pepper in some private investments that have a chance to outperform inflation. We can talk more about that, as well as hard assets. So in a year like this, hard assets have given a great benefit. You've got gold up 45%, silver's up, I think, around 62% today. Got Bitcoin and Ethereum up in the 20 to 30% range, volatile. But so those are the kind of things that might be the answer to what else can I do outside of just traditional stocks and bonds.
All right. So it sounds like, and going back a little bit also to your last answer, the other question, energy, for example, is cheap. So you're getting safety there, but also you have these like barbell portfolio strategies where you have private markets and venture capital. So it allows for potentially outperformance, but also safety of principle.
I think that's the right way to look at it. Like when we take risk, we do take risk. Venture capital is a high risk area. There's a number of things we do. Cannabis investing is a high risk area, but it's a calculated risk. And like you described it, like a barbell, like a weightlifter, weights on both sides. You have some bets that are high risk and you acknowledge it, but offsetting that, you've got gold and silver. You've got farmland, perhaps. You've got, things that kind of can weather a storm, earn you money, but if things go really bad in the world, they're probably going to be beneficiaries. Right. So we like that pairing as opposed to, hey, we're going to diversify and just own a little bit of everything. Sometimes, especially a market like this, we like to have a couple outliers over here. I put cryptocurrency in that too, high risk but high reward. And on the other side, have some really stodgy things, which can even include short-term treasuries. That if things don't go well, you've got a layer of safety and something to fall back on.
Well said. Well said. I really like it. Okay. Let's go to the next question, Brett. So, speaking of gold, at Novarsk, I'm sorry, butchering his name, Novarsk77, he asks, when do you think we'll see gold at $5,000? This question would have sounded crazy, right? 2 or 3 years ago. But 4,000 is around the corner. And
Yeah.
we've had guests on Wealthion that thinks gold is going to go to 20,000. What do you think, Brett? When do you think we'll hit 5, if we will?
Yeah. Well, listen, let's acknowledge that timing is always a very tough thing to tell. I
Yeah.
think it's on a trajectory to get there. I don't think the run is over. Although anytime something runs, stocks, bonds, or gold, do not be shocked if they have a period of pullback or consolidation, right? That could definitely happen. I mean, gold as of today is $3,842 when I last looked, up 45% this year. So the move to 5,000 is about another 30% move. Now, I believe gold is making a little bit of a catch-up play to the amount of money that's been printed in the system, that it had been lagging it for a long time. People are waking up, both individuals, central banks, institutions. So the race to 5,000, that could happen in the next 12 months, but it might not be a straight line. We don't do projections like endpoint specific projections, but we think we're in an era where governments will continue to have to print money to meet obligations. As long as that's true, gold, silver, tangible hard assets of limited supply are likely to continue to go up. And especially gold and silver, because they're unique in that there's nobody else's liability, right? If I own a bond, there's a counterparty I have to rely on, whether the US government or a big corporation. Gold and silver is just a physical asset. I'm not relying on a promise to pay from anybody else. So if the promise to pay part of the equation comes into doubt in the world, I think more and more money will flow to gold and silver. So I don't know if I exactly answered that, but I think we're on the path to those kind of levels and beyond.
Want to share with viewers, you had a great interview with Maggie Lake on gold, and you went deeper on your insights on it and why it should be a part of your portfolio. So please catch that. I will link it as well below in the description. That was super interesting, Brett. So now this is a question that I am dying to ask you, because you probably remember I'm a fan of the Austrian School of Economics, so like you guys. So interesting username. On File is asking, could the all-time high in stocks really just reflect the all-time low in currency purchasing power? Is the Austrian school's crack of boom playing out?
Yeah, I think it's a great question and something everybody should be educated on conceptually. Normally the idea, as I describe it, of a crack up boom is a point where people start dumping a currency because they see where it's headed, and they'll put worthless paper, those dollars, in anything else. So you can get this explosive move in asset prices because everybody's trying to get out of the paper, right? You've had that. We've talked in some different interviews. You had that in Weimar Germany after World War I. You had that in Zimbabwe. You've seen it in Argentina and Venezuela. The stock markets have soared at the same time currencies falling, right? Are we there yet? Probably not, because the US dollar, despite weakness, is just kind of like struggling along, right? It's not as if everybody is trying to get out of dollars as quickly as possible as they might be in Venezuela. However, I think we can draw some insights this century. In fact, if you go back to the year 2000, beginning of the century, and you go through a couple days ago in the stock market, the S&P 500 in nominal terms, without factoring in inflation, is up something like a little over 7 times your money. Sounds great. But if you inflation adjust it and you say, well, if I apply inflation, how much is that really worth today? Because my dollars don't go as far. It's a lot less. It's something like 3.8 times your money. Still okay, but not quite as much. What if you divide it, instead of by the CPI, which a lot of people don't believe is accurate, and instead you divide by gold, and you say in gold purchasing power terms, what has the S&P 500 done? And it's lost about half of its value since 2000. It's at about 0.55x what you put in. So if you want to look at it that way, yeah, it's a race to the bottom in fiat currencies. It doesn't mean we're at an imminent point of collapse in these, but I think smart people know that they will keep printing money until the money is worth less and less and less. And it's why, the house in the 70s that was 50,000 is now 500,000. All the pricing we see is because the money keeps multiplying. So, I do think that is what we'd want to watch for. And if you really see signs of a loss of confidence in the money itself, then I think you set the stage for what this is referring to, a crack up boom, where all of a sudden people race out of paper and into anything else, literally anything else that has or might sustain its value.
I remember in that interview about gold that you did with Maggie Lake, putting on screen $1 trillion banknote from the Bank of Zimbabwe.
100 trillion. 100 trillion.
Yeah. It makes no sense, right? But I think what you're alluding to also is that there's not necessarily an immediate crash to everything, but it's an ongoing thing. It's been happening for a long time, since 2000, and it's just eroding people's purchasing power. And more to the point, we're all noticing it, but despite it not being reported in things like gold, right, you'll see the S&P 500 not being worth what it's worth nominally in US dollars. And it's breathtaking, frankly, and it's scary.
It is, and there's skeptics that say, listen, the market, like I just said with gold, it's not really up relative to gold, right? So you're actually losing in the long run relative to something that you believe is stable purchasing power, which gold has been over the centuries. So it's a real dilemma for investors. And it doesn't mean you shouldn't own any stocks. It's just an acknowledgement that it's denominated in paper. And if stock market's going up, but the paper value is going down, you've got to think about what that means and how you counter that over time. Because really what people want to do is protect their purchasing power, right? And back to the countries I was describing, whether Venezuela or Zimbabwe, their stock markets boom. They didn't have stock market crashes during these hyperinflations. They went straight up, but they didn't go up enough to retain purchasing power. So even though maybe a stock market was up tens of thousands of percent or some ridiculous numbers, the currency basically went to zero. So, it can be very misleading, to look at some of that data. But I think the key takeaway is purchasing power, right? You want to make sure you're earning money, and whatever that dollar amount in your portfolio is 10 years from now, it actually buys you more than what you have today. If it's a bigger number, but it buys you less, that doesn't do you any good.
Yeah, absolutely. There's a huge difference between nominal returns and real returns. And hearing you, what's scary to me is that if the returns that the stock market gives you, and the stock market, it's supposedly the reflection of the wealth creation in the country to a significant degree, then where are we heading, right? And maybe again, it's in reference and allusion to what this viewer is asking. Well, perhaps not as much wealth is being created because of all this influence of the government on the price of money, on the fiscal deficit, et cetera, to what is actually a productive investment of capital. I don't know if that makes sense.
It does. And I think, I had a client that was a consultant a company years ago and used to say, you can't shrink your way to greatness, meaning you can cost cut, but eventually you need to grow. And I'd say the same thing for governments. You can't print yourself to greatness. You've actually got to have organic growth. You've got to create value. If you're just relying on the printing presses, ultimately, I don't care if your piece of paper says you have $1 million with a $100 trillion note, it's just a paper, instrument that's not going to be worth anything. So again, I don't think we're there yet, but it clearly is on our mind about what is an end game to this? How do we get out of, this predicament? And it's something to think about. Now, there are scenarios to get out of this that we can talk about. They're not easy, but we can talk about it a little further if you'd like.
I'd be super interested. Yeah, of course. We can also leave it for an evergreen in a different interview. But you want to give us a little short take on?
Well, listen, this is more hypothetical than anything, right? The hypothetical answer would be there's 38 trillion of debt roughly in the U.S. Of course, there's tons of obligations that go well beyond that. If you look at unfunded things that don't go into that number, but if you just take that number at its core, you could say, well, I don't know, if the government could secretly accumulate enough gold and then let it massively revalue, what would gold have to revalue to? And in the math I did back of the envelope is maybe 142,000 an ounce gold wipes away all debt. Now that people would say, well, that's a ridiculous number, and it is, but that's a path a government could take. Or maybe Bitcoin. Maybe it's a slow and steady accumulation of Bitcoin or some other asset in stealth. And once they have adequate reserves of it, you let the world know you have it, and thing goes to the moon. And all of a sudden, you've got an asset to pay off, most, if not all, of your liabilities. Now, that might be a pipe dream. This is a little hypothetical, but the point is the assets on the balance sheet matter as much as the liabilities. So we've got to think that way going forward.
I agree. I can't agree with you more. There's also huge assets on the amount of land that the federal government owns. That would wipe out the debt as well, if I'm not mistaken. All right, Brett, let's get to the final question.
Okay.
And Jonathan Ferguson asked, WindRock has warned that the traditional stock and bond portfolio, so what we were talking about, may fail in today's environment. How does your investing philosophy turn into portfolio strategies, actual executable portfolio strategies? And can you share an example where this protected a client's wealth? Is that something you can share with us, Brett?
I could share some high-level thoughts, sure. It really depends, Mario, on the market environment we're in. I'll give you an example, and it goes back to coming out of COVID when we were at 0% interest rates. A lot of advisors in the industry kept recommending bonds because they say, well, pricing's efficient and you still need stability. And they'd have portfolios of bonds yielding almost zero. To us, that didn't make any sense. Why would I lend somebody money to get paid back basically nothing but my principal and take risk? So in that time period, we did a lot of private lending, and we continue to do that. Again, this is a private market opportunity, but a lot of the opportunities we had would have yields going in 8 to 12% kind of ranges. And we avoided, in large part, traditional bonds. So for a number of years, when bonds actually had negative returns, we had, opportunities in private markets and private lending to do something different. And, you have to have access to those things, but that would be an example of how you can think a little bit differently in a particular market environment and not feel beholden to, oh, well, everybody thinks I need bonds no matter what the price is, right? I mean, imagine in Europe if someone told you, yeah, buy these bonds, you have to pay the person you're lending money to. That's what it was. I mean, it's absurd. And yet it happened, right? So I think thinking outside the box and just applying some good old common sense and logic is how we sometimes find opportunities. And they're not always that easy, but that is an example of, a time period and something we did that was different than most.
So you're able and willing to go outside traditional markets and, find an edge there. And you have that flexibility, not only in your mindset, the firm's mindset, but also the way you structure things for clients. Makes perfect sense. All right. That was super interesting. So that's it for today. Brett, thank you so much for being here with me. It was tremendously insightful. And I hope we can do this again.
Okay. Great chatting, Mario.
And to everyone watching, if you found this helpful, give the video a like, please share with others. And remember, if you liked for Brett and his team at WindRock to review your own portfolio, you can sign up for a free portfolio review at wealthion.com/free. Once again, that's wealthion.com/free. Thank you again for joining us, and we'll see you next time here on Wealthion.
If you're looking for a simple, secure way to invest in physical gold and silver, check out Hard Assets Alliance at hardassetsalliance.com.